2.5 million, and it was producing about $100,000 of cash flow. Well, what if you could take that asset, sell it, and now when it goes into the deferred sales trust, it's producing $180,000 or $190,000 of cash flow, right? You just increase that margin for your financial freedom. That perhaps, given the increased cost of living, given the increased inflation, things like that, you have an opportunity to get some financial freedom. And so, probably all of our deals that we've done have a portion of this. And I would say the one of them that kind of really sticks out for me was for a client that sold a beach house near Santa Cruz. And this house was their former house that they lived in 20 plus years ago. They bought it for around $900,000, and it went to as high as about $8 million. And they were Airbnb-ing it, so they're actually getting some good cash flow. But essentially, their overall cash flow was not maximized to the actual, $9 million. Now, this particular client, she was in her 80s, and so she sold it as a way to basically more than double her cash flow and get complete financial freedom, which leads into the second freedom, which is location freedom. And this particular deal had a client who was in his primary home, and he was actually still living in the home. It wasn't even a rental. All of his kids are gone, and he's looking at about an $8 million sales price. He had about $6 million of debt or so, and his basis was about $6 million. And so even above his 121 exclusion, he had this tax bill. And what was challenging for him was he was like, I have so much debt, I have so much tax. If I am to sell, I want location freedom. I want to be able to move out of California. I want to be able to relocate. I want to get a little bit lower cost of living, a little bit slower pace of life. I want to retire. I actually want to get to Nevada next to family. He wanted location freedom, but he literally felt trapped in his house because of the tax. And enter the deferred sales trust as the solution for this. What's really cool is you don't have to do a 1031. You don't have to move out of your house and try to rent it out. In fact, he could just sell it, defer the tax, and get cash flow and be able to relocate to a new state, which also has a lower income tax. So that was really cool. So he has location freedom, right? He's not tied to the house or the location he's in because he feels trapped by this capital gains tax. In fact, his quote was, Brett, if it wasn't for the deferred sales trust, we wouldn't have been able to sell the house because after commissions, closing costs, and capital gains tax and debt payoff, I'm basically walking away with nothing. So I might as well just stay stuck in my house, but I want to sell it. All my kids are gone, right? It's a huge house right on University Avenue in Palo Alto. So he was able to unlock location freedom with the deferred sales trust. Pretty cool. The next freedom, so we talked about financial freedom, we talked about location freedom, and now we're going to talk about time freedom. So time freedom is the number 3 freedom that the deferred sales trust unlocks, in that it allows you to get your time back. And what the best example for this is a lot of our entrepreneur business owners that are looking to retire. A recent deal that was closed for a client was a New Jersey dentist, and he had worked as a dentist for 30 years. And for him, he's going, Brett, I'm ready to retire. I'm going to sell the business anyways. He's selling for around $2 million. His tax liability in New Jersey, which is one of the New Jersey, New York, and California are like the 3 worst, right? But somewhere like 40%. And he's going, Brett, I've worked for 30 years. This is really my retirement. I mean, I have some, but this is going to determine my finances, but also it's going to give me my time back. This is really what I want. I want to be able to enjoy my retirement. So if I can sell now, I don't have to work as long, right? I don't have to wait a few more years. I can actually sell in today's value because I have an extra basically 40% because he had a 0 basis on a $2 million sale, right? And so instead of getting, and saving and working a few more years to get more for his retirement, he's able to execute. And guess what? He did this about 1.5 years ago before the market has really shifted. So he got a good valuation for his money where interest rates were still pretty low, where the buyer could still buy at the right time. So who knows what the value of the practice would be today had he not sold it with interest rates that have nearly doubled. Right? So he gets his time back. He gets time freedom to be able to retire. He gets time freedom from not having to work another few more years. And that's amazing. Right now, he's completely passive. For him, he went all into the stock market. Actually, he put a little bit of real estate too, about half and half, actually, now that I think about it. but it's a passive real estate deal. It's not anything that's active. So he got his time freedom back. So we have financial freedom, location freedom, time freedom. The next one is entrepreneurial freedom. This is probably my favorite, right? Because I'm an entrepreneur at heart. And I wanted to find something for my clients after the 2008 crash that gave them the ability to be real estate entrepreneurs, but when the timing was right for them. So what does that mean? That means selling high and buying low when it makes sense. That means selling high multifamily property and maybe starting a business with the money, right? All tax deferred. So the deferred sales trust unlocks this entrepreneurial freedom by doing just that. You can sell any type of asset, whether it be cryptocurrency, whether it be a business. In fact, a recent deal that Jake and I did, we helped a client who exited cryptocurrency. She bought it and she used to work for Google, but her biggest dream was to be an entrepreneur and have her own tech startup. This is out of the Silicon Valley. So she bought some cryptocurrency, Bitcoin in particular, at 50,000. It went to 50 million, and then she was able to exit 5 million of that. And then with Jake and I's help and the tax team's help, invest some of that into some securities to get some diversification, some liquidity, but use a big part of that to fund her tech startup with her college roommate, right? So her dream was to be an entrepreneur. She wanted to have that entrepreneurial freedom, right? And the deferred sales trust unlocks the capital, an extra, in this scenario, about 37% of taxes deferred, which became the capital to launch the company. Pretty awesome. So you can be an entrepreneur. You can have freedom with the deferred sales trust. The last one is estate tax. And I'm actually going to pass it over to Jake because I've been talking a lot. And now I'm ready for Jake to jump in now. He's here with us. So Jake Miller is with us, CFP financial advisor with the deferred sales trust. Jake, how does the deferred sales trust provide estate tax freedom for those that are subject to, these massive taxes?
Brett, you've been doing a great job. I think telling stories helps people relate and helps them understand individually and personally how this might help them in their own situations. I think a number of the people here in the audience right now perhaps better understand the DST because of the stories you've shared. In addition, in regards to estate tax, so we have this big scary monster, so to speak, and I'm not just talking about tax in general, but estate tax, and it's big and scary because it's typically 40%. Now 40%, that's huge, especially if you talk about sales tax, income tax, capital gain tax, dividend tax. You talk about all these other taxes that people pay every single day. And of course, when it comes tax time, which we just passed one of those other deadlines a couple of weeks ago, right? And then here in the spring, there's more tax deadlines. We're always very conscious of whether it's self-employment tax, whether it's C Corp tax, whether it's pass through to my 1040 and I'm subject to ordinary income tax, what have you. At the end of the day, if you pay all of those and you think that you're done, you might be wrong. If your estate has grown sufficiently enough that you are surpassing those exclusions, which right now for another couple of years, that's $24 million married filing joint, just over that threshold, right? If your estate is greater than that and you hope or wish or desire to pass it on to your heirs without doing some entity structuring, some layering, and some of these other things, you might be disappointed that what you hope to pass on might get chopped up and diced up again so that 40% of it can go to the government in estate tax. And the DST 2.0 could be a planning solution for part of that. Essentially, people and individuals who are selling off capital assets right now can freeze the amount that stays inside of their taxable estate. They can freeze that amount and be reinvesting in the Deferred Sales Trust 2.0 and having it grow outside of their estate, so that as an estate planning tool, not only a deferral of current tax, but as an estate planning tool, the DST can help their family legacy in years into the future. I don't know if you were looking for something more than that, Brett, but that's kind of like the gist that I like to share.
And let me give you the deal, sir, that this happened on. Okay, so the client was worth $25 million, and all of it was in real estate, and all of it was inside of their taxable estate. And so, A, they weren't diversified. B, they were active owners and management. C, they're looking to move into phase 3 of more retirement, more passive stage. And so they were already financially free, but they weren't time free, and they weren't estate tax free. Right. And in this scenario, the deferred sales trust for these two freedoms were so important for them because the ROI was exponential. Because on this 5 million, had they stayed the course of the blockbuster 1031 swap until you drop, yes, they would have got, their kids would have got a stepped up basis, which means that upon death of them, their kids could sell at the same stepped up basis and walk away capital gains tax free. However, it doesn't give the estate tax freedom. In fact, it would still be subject to estate tax, which is 40% of anything above 22 million married, or 24 million married. And now they're in their late 50s, early 60s, so they're young. So they've said, look, we're gonna do some planning here. We believe with our net worth where we're at, we can easily double this, maybe even triple the money by the time we actually die. And we'll just do it right now. Let's, in one single day, without giving away to charity, without having to buy a bunch of life insurance, without having to have a bunch of new kids and try to gift it all away, we can sell, move it outside the taxable estate without having to give it any gifting, right? Not give up any of your gifting exclusion amount. And now anything above on this 5 million, as it grows over the years, let's say it grows to 15, 20 million, is all outside the taxable estate. So we have estate tax freedom. We've eliminated 40% death tax. So that's what happened. We helped them sell and exit the property using the Deferred Sales Trust 2.0, the Deferred Sales Trust Plus, move it outside the taxable estate, and they're very happy about that, right? Because we have an exponential return on the future and right now if they were to pass. So that is the 5 freedoms: financial freedom, location freedom, time freedom, entrepreneurial freedom, and estate tax freedom. That being said, if anyone has any questions or thoughts, you can put it in the chat. You can also unmute yourself as well. Jake, I do want to talk a little bit about some live deals that we're working on and maybe some questions or objections that we received this week. Is there anything in particular that kind of comes to mind with one that you want to dive into there?
Yeah, so let's talk about the trustee. So Brett, can anybody be a trustee?
So technically, like trustees, and in regards to someone being a trustee, someone can be a trustee. The question is the relation to the person too close where it's going to fail? So what does that mean? That means, can my brother be the trustee for my deferred sales trust? The answer is no, right? It's a relation. What if it was my best man at my wedding? No, it's too close for control. What if it was an employee or someone where I had some kind of influence or control over, basically prior to getting all of this set up, becomes, we believe, too close for what is allowed. And so not in the sense that anyone can be a trustee, yes, for one part of it, but the other part of it, no, because now the people who created this also recognize that it's not just a warm body to be a trustee. It's somebody that actually understands the structures and has been trained, has been, in a sense, certified by them to be able to execute this. So we don't let anyone just be a trustee, because it's just like, can anyone be a doctor, Jake, right? What would you say to that? Well, yeah, if you go through the training and the residency and the thing and all the things and you get all of that, and yeah, you can become a doctor. But we always say, don't try this at home. You want to make sure you're working with those that know what they're doing. So Jake, does that answer the question?
It does. Now let's just talk a little bit about investing in a DST. Is it the same thing as investing by yourself?
In the sense that it's open source, you can invest basically about anything you want to the extent that you have diversification and some liquidity into the trust. We have some guardrails there. We want to keep at least 20% liquid at all times. And liquid can mean investment grade securities. It can mean the bank. We want to make sure that we don't overstep that. In regards to like investment options, yes, stocks, bonds, mutual funds, insurance, real estate, passive or active. You can do all that. Business ventures, ground up development. The only kind of nuance here would say the trustee has to approve. Part of that is just the nature of the structure. If you had unilateral control or too much control, where there's no, kind of basically decision. This is also why we need a third-party financial advisor, because sometimes people say, well, can't we just do our own financial advisor and just trade it ourselves? The answer is no. Why? Because of the integrity of the structure, which is third-party unrelated trustee, third-party unrelated financial advisor, and also making sure that we don't have constructive receipt. We never want that.
Yeah, so essentially they can invest in almost anything, right? As long as it's not personal in nature. But from the standpoint of a lot of financial advisors, there's a lot more than just marketable securities. Any type of asset for investment purposes, you may participate in within certain thresholds. So there's some guidelines, right? And we help people with those guidelines. We help them know what their options are, and we enable them to invest in what makes most sense for them.
You nailed it, right? Just like if you showed up to Jake and you didn't use the deferred sales trust, and you said, "Hey, Jake, as a financial advisor, would you do a financial plan for me?" And he's going to say, "Sure." You're going to fill out a risk tolerance questionnaire. He's going to ask about your goals. He's going to ask about your needs and your wants. He's going to basically, like a doctor, do an X-ray of your finances in your wealth plan, and then he's going to prescribe a solution, right? A plan, some investment opportunities, and with your approval, he'll invest in those. The only difference on this scenario is he's also going to look at the trustee and the note holder and say, "Hey, with your approval, here's what I suggest based upon the note holder's risk tolerance." It's also, by the way, how we determine the interest rate on the promissory notes, which is also a good thought. So, Jake, how do we determine the interest rate on the promissory note?
We look at what's commercially reasonable in the time of, based on their risk tolerance. We align the two, and we come up with a promissory note interest rate.
Exactly, right? So some people say, "Why can't it be 25%? Like, why is it 5, 6, 7, or 8?" Well, what would two unrelated parties in a course of transactions on a seller carryback do, given the current kind of conditions and based upon the risk tolerance? So that's how we've dialed this in. And so the recipe, I also had a question this week too, Jake. They said, "I mean, this is 453. Yeah, well, anyone can do this." Well, yeah. So what's proprietary about it? It's like, well, it's not the 453 is proprietary. Anyone can use the same tax laws. The proprietary part is the recipe of putting all the things together and then executing on the business plan that's been going on for 26 years, thousands of closes, billions under management, all the IRS audits. That sequence and that execution is the proprietary part of this, which also is why it makes sense that I haven't really heard of it, or not everyone's doing it, because not everyone has been trained or knows how to do this. This is also part of why we're having this masterclass, to try to you're not going to give any secrets away. There's still NDA stuff that we're holding back, but essentially give you the meat and potatoes of the basics, the structure, the strategy, and hopefully also build confidence. And yeah, these guys are Navy SEALs when it comes to focusing on this. And that's what we like to deliver. Does that make sense, Jake?
It does. It absolutely does. Now, Brett, another question that oftentimes comes up, and came up this very same week. If I have a partner who's perhaps a minority partner, and so my tax paying is a lot more than my partner's tax paying, do we both have to do it, or can I do it and he can choose not to?
So generally speaking, you can go your separate way. So one can just pay his tax, the other can just defer his tax. In fact, we just did a deal in San Diego for 4 partners on a $13 million car wash sale. They bought the land. It was an old taco stand in Chula Vista. Anyone ever in San Diego? Chula Vista, it's like just a vacant piece of land with like a small taco stand. The guy's doing the work. And they came to the guy at the taco stand and said, "Hey, we want to buy your land, but we want to put a car wash, but we're not going to put you out of business. In fact, we're going to give you 2 or 3 times as much business, because inside of this car wash is going to be a restaurant, and it's going to be your restaurant. And you're going to run your taco stand, but we're going to build it all out for you. You run your business, or we'll probably double, triple your money, because all the people that are coming in for the car wash, they want a place to eat and they want to hang out. We're going to have they have the soccer game on, or the football game on the big screen, and they get to have amazing, Mexican food." And so he said, "Sure." So they did that, and they built this structure, $4 million, and it was valued at $13 million. Actually, they thought it was for 10, but the guy showed up at $13 million. By the way, this is a year ago. Talk about timing the market, right? They sell at $13 million, but guess what? Of the 4 partners, one wants to pay his tax. He's just older. He just doesn't want to, deal with the 1031. He doesn't want to do a deferred sales trust, so he pays his tax. But the other 3, they're like, "No way, we don't want to pay 40% in tax." So they deferred it, and they each had their own individual trust. So it's important to understand that each single or married couple can have their own trust, and the other partners can have their deferred sales trust, or the other partner can just pay their tax. So Jake, that is how the partnership can be seamlessly separated, and each partner can have their own money when they want it.
Now, Brett, had that deal been done with a 1031, could they have done it that way?
So in a 1031 exchange, the whole entity must move. So unless there was some kind of drop or some kind of different way that they structured it, in this scenario, it was an LLC. So I think the answer is no. The whole entity would have had to move, meaning all the partners would have to go together, and all the partners would have to stay in another deal. The other thing about a 1031 is they'd have to buy a $13 million property, equal or greater value, but they're in the business of buying land and developing, right? And then using the money that they sold to develop all of this. So it was literally perfect for them. This goes into, by the way, the entrepreneurial freedom, which is the fourth freedom, right? They want the freedom to be entrepreneurial, to create the business, which is the car wash, to build the business or to build the real estate, which is their construction business. They didn't want to have to buy something that's existing at 13 million or a structure that's already built. They're not in the business owner. They want the entrepreneurial freedom to use the capital to fund that venture, which is what they're doing now. Now they're being patient, by the way, which comes, this also fits into time freedom. It's not only time for your energy, it's also the optimal time to invest. So they haven't seen any deals that make any sense. In fact, they've been in securities and they've been in basically cash for this last 6 months because they've been very cautious. So now the real estate market is starting to turn. So they're just waiting, right? And they're going to buy low, hopefully, right? And construct the car wash when it makes sense.
So rather than making certain tax strategies that are super well known, try to fit, even though it doesn't really match up with their objectives, they were able to receive some knowledge, expertise, some training, some education on the deferred sales trust, and actually accomplish their goals and objectives more perfectly, because as entrepreneurs, they were able to continue to do what they needed to do as entrepreneurs because it was best for business and do what was best for taxes.
And what's best for the partnership, right? They didn't have to give up anything. So, and that was part of their thing. They're like, Brett, wow, you're checking off all of our boxes of why to do this. And they had met me. They're like, we're closing in 21 days. We found you on YouTube. It sounds way too good to be true, but help us understand this, right? And even then, like for 20 days, we went as much as we could with them. And they said, we are taking a step of faith and trust in you guys because we still don't, we're still trying to understand this. Like, and you can't blame them. It's like 10,000 hours you can't squeeze into 21 days. It just, it's hard to do that. But we were able to educate them enough, talk with clients enough, banks, this financial advisor, tax attorneys, all of it, so that they move forward. And yeah, so they're so far so good. And I hope, and I also try to wait for people to be clients for a period of time before I have them on. But and we don't, we just ask, and some clients are more private, so we'll see. But at one point, I like to bring them on to this masterclass and have them share their story so you hear it directly from them.
Brett, do you mind if I call somebody out of the audience real fast?
Go for it.
Okay, Eddie from London, are you here with us right now? Let's just see.
Yes, I am.
Fantastic, Eddie. You've got a couple invites with us here today. Do you mind maybe introducing them? I know one of them, Rahul, has a question. So if you don't mind introducing them, and if they want to ask it to the audience, if not, I can read it because it's here on my message list.
Yeah, sure. I can introduce the two people that I came on today. Yeah.
Yes.
Yeah. Okay. One of them couldn't make it. The other one, his name is Venantis.
Okay.
He's actually my longtime friend. We've been friends for the past 17 years, I'd say. So nearly my whole life. We recently entered business together in the whole M&A field, and he's actually the executive of a deal sourcing, so finding us deals, talking to brokers, talking to sellers, trying to get some off-market deals, and yeah, he's been doing great. He's been learning M&A on the side as well. So every time we jump on the call, we find out more information. I answer questions. If I can't answer something, I go to Jake, because Jake is the man. I'm not just saying that because he's here. But yeah, that's what he does. The other guy, he's also that was supposed to join. He also does the same thing, but him and V work side by side to get these deals done for us as well.
Gotcha. Well, appreciate that, Eddie, and thank you. And then Raul, I see your video, and you had a question in the chat. I apologize, I confused you with another person, but would you go ahead and introduce yourself and ask your question?
Yeah, sure. My name is Rahul. I'm actually a broker. I'm with EXP, and I've been in business for almost 16 years now. I met Brett actually at the EXP con, right in the elevator, and I would say that Brett is good at his elevator pitch. He not only told what he does, but he brought the value too.
That's great. I appreciate that. I do remember, right? It was fast, right? There's a lot of we're moving. We're going through all the different speakers, and so yeah, we'll keep going.
And that's what I teach all my other agents in my office to sharpen your elevator pitch. Anyway, so I'm going to talk to Brett about what I'm trying to do. But in parallel, I have a question about a client. So they have an LLC with 80 and 20%, about 80%, 81%, 19% ownership. The guy with 80% would be interested doing a DST type deal. The 19% would not. How would that happen? And the corporation prior to the sale, because this property would be, it's an LLC, but actually it's a franchise hotel. So anything we do, something to the LLC, make any changes, that would trigger some, red flags with the franchise, because they have given a franchise to this particular LLC. The moment something changes, that actually gives them an opportunity to do two things. One is they obviously for the paperwork they would ask money, like which is like minuscule, but about $10,000. But more importantly, they want to get this particular new entity being approved by the franchise, so whole process. But the bigger problem might turn out to be that the moment this happens, generally the franchises, the hotel brands would come back and say, you know what, this is a time when we want you to do this, something called PIP, which is property improvement punch list, POPSIP. So they want, because it's in the franchise agreement that moment some bigger changes happen in the ownership, the PIP would turn up, and that might be substantial. It might be a $500,000 investment and stuff like that. How do we mitigate? Because it's not about selling. Let's say the sale doesn't happen. Now we have done all this, and now we know that we are dealing with a monster in the room.
Okay, let me see if we can capture that. Thank you, Rahul. That was awesome. We'll take it one step at a time. So yes, the partner who has 81% can use the deferred sales trust. I mean, I haven't seen the LLC. We've done an X-ray of the operating agreement and the deal. But as far as the deferred sales trust is concerned, typically what we do is we assign the interest of that 81% prior to a new buyer coming in. And then the other 19% can just take his cash at closing. And so basically it's just creating one more layer between the cash receiving to the 81% owner and the trust jumps in right in between. And you assign the interest to the trust. And so instead of receiving the cash, the note holder, the client, receives a promissory note from the trust, and the trust receives the capital. So it's just that extra party, and the trust ultimately sells it to the buyer, whoever that buyer is. So let's say it's a $10 million deal. Keep it simple. $8 million is what's owed to one partner. $2 million is what's owed to the other. It's going to be an $8 million promissory note. The buyer is going to come with the $10 million. He's going to give $2 million to the one partner. He's gone. The $8 million is going to go to the other, to the trust. And the trust is ultimately going to just sell the assets all in one escrow. It all happens simultaneous close. So that's number one. Number two, does it affect the buyer or the franchisor? Well, the franchisor or the franchise, they have to approve of the buyer coming in, right? And so a new buyer has a new plan. It doesn't affect the buyer, and the franchise shouldn't care because they're having that new buyer qualify for that, right?
Yeah.
So if it's, well, one partner is going to buy the other one out, well, then it's going to be on that, whoever that buyer is, they're going to have to qualify there. So the deferred sales trust is the exit of the whole thing, right? So they're no longer involved in the actual asset anymore. And so to that extent, I see no issues whatsoever. And it sounds like it could be a perfect plan. Did I answer your questions there, Rahul?
Yeah, but my question is that are they making any changes in the corporation? So do we have to record something at the city or the county or something?
Not necessarily. So is it a C corp, S corp, or LLC?
LLC.
Yeah, it's an LLC. What we found, generally speaking, every deal is a little bit different. Okay, it's in a Rubik's Cube, and I haven't seen all the parts of the cube, right? Neither has our tax team. We haven't done an MRI or an X-ray. So don't hold any of what we're saying as gospel here, right? But generally speaking, they can assign the interest of the LLC or have option language to do that at the close of escrow. So in the purchase and sale agreement, there will be an addendum that says so-and-so's 81% interest has the option or the right to assign its interest to such and such trust, right? Before close of escrow at no additional cost to the buyer, something along those lines. Fast forward, the deal's about to close. He assigns the interest, right? Maybe the day before. And even sometimes, depending on the deal, we might even assign the interest and the money still goes to the LLC at closing, and then the LLC turns around and pays the trust. So there's a couple of different ways to do it. And so I would just say set up a no-cost consultation call with me, Jake, and the tax team, and we'll go through this in detail. and we'll move the cube around and we'll try to get it all lined up. Does that make sense, Arul? Go
Yeah,
ahead.
it does.
Question.
The second question is that the first guy got the DST done. He's happy. The second guy, can he do his 1031 exchange?
So it all depends on how they've structured that LLC, and how that's set up. I don't know without doing the X-ray. I'm not having the tax team look at it, right? So I'm not certain on that.
Okay. What do you want to see? What do you need to see?
We need to have the tax team look at it. So I would say, and this is, so we need you to get on the call with you, me, and the client, right? And so and Jake and the tax team. So that you're getting into, and this is good questions, Rahul, but you need to just set up a call with us, right? And it's complimentary. The tax team could be charging $1,000 an hour or whatever. They don't charge, we don't charge. So just jump on the call with us and we'll go through it, right? The deal's at least $1 million net proceeds, $1 million gain.
Yeah, it should be in $6-7 million.
Okay, good. Yeah, so that qualifies there. So yeah, go ahead and set that up with us. By the way, so Jake, I'm going to pass it over to you. I've got a dentist appointment for the tooth right here, right? I've never had a cavity, by the way. It's been good, but I feel like I'm getting old and things fall apart. So I've got to jump. So I'm going to pass it over to Jake and Pierce to finish it out. So thank you, everybody, for attending. Go to capitalgainstaxsolutions.com if you want to connect with me. Jake will talk about where he's going to be, but passing over to Jake to finish it out, okay?
And while you
Brett,
leave,
before I let Brett go, is it gone?
No,
Brett,
I'm here.
one last question for you. So I'm getting started on learning everything, and I really need to talk to you about. I've got a lot of questions. I think it would be not a good idea to talk here, but what is a good time I can call you?
You can just anytime. You can call me anytime. Okay. And so you already have my number. Just call me, right? Okay. But it's always best to set up, if you have a live deal or who, just set up a time with me, you and the client. And then I also have a 15-minute little book. You can book me there as well. But ask your questions. Jake is amazing, right? And so you can also look at my assistant, just put it in the chat. Call consultation. She just put it in the chat. You can click on that, okay? And schedule a time.
Okay, perfect. I'll learn more about this before I take my client into the call.
Okay, yeah, take your time. We don't want to rush that. But by the way, if it's a live deal and it's set to close here in the next 30, 60, 90 days, we absolutely encourage you to get going as soon as you can, because you can run out of time and the deal can go too far. And then you're calling us wanting to do it. And all of a sudden we're like, sorry, it's too late, Rahul. So make sure if there's any interest at all, let's jump on, let's work through it, okay?
Okay, cool. Thank you.
All right, thank you.
all right, well, very good. And of course, live deals are sometimes the best deals for learning. Go ahead, Pierce.
So I just wanted to, I didn't mean to cut you off there, but I was doing I had a talk with a gentleman yesterday. He might actually even be on. I don't know if he's on or not, but he had a really interesting question. Brian, if you're on, do you want to ask your question about putting cash into a DST for deferring future gains?
I wrote that in the chat section, but why wouldn't somebody with cash who wants to avoid future capital gain and estate tax want to enter a transaction like this?
Interesting question. So typically cash, if we're recording things as we should on our books and everything else, is treated just like money in the bank, or is treated just like any other asset. It shows up on the balance sheet. Whether it's your personal financial statement or whether it's a business balance sheet. So help me understand a little bit more about the transaction. Are we talking about like a laundromat type business that is very cash centric, or are we talking about somebody who's just always received cash as their payments and they've accumulated it for a long period of time?
No, somebody's just sitting on a pile of cash, sitting on $5 million, right? They're in a taxable environment. If they invest, anything that they realize is currently taxable as income or capital gain tax. When they die, it's going to go through the 706 and be estate tax, right? So they don't necessarily need the money or income from the money, but obviously in a situation like this, they could take the income if they want.
Yeah.
Okay.
Okay.
But they would want to defer the capital gain and income tax going forward, as well as avoid estate tax when they die.
Yes. Now, for the deferred sales trust, for us to utilize it, there must first be an eligible transaction. So we don't just set up a deferred sales trust planning for estate taxes unless there's something being sold. Oftentimes, if they're going to sell their house, if they're going to sell a property, if they're going to sell a business, they're going to sell out of Bitcoin, they're going to sell. I mean, all of these stories that we've told today are scenarios where there was first an eligible transaction that warranted the creation of a deferred sales trust so that we could take a transaction that is going to happen and defer the recognition forward of that transaction, meaning we're not going to report it as taxable this year. We're going to report the transaction, but we're going to report it underneath the trust, and therefore it's not taxable under this business trust. In your scenario, how do we get dollars back into the digital system or back into some kind of transaction in the future when needed, while being able to not raise red flags and being able to do everything correctly, but in a way that doesn't cause 1, red flags, 2, an audit, or 3, a taxable event? That's a different discussion. That's a different strategy. We can definitely go over that. Pierce, I think, had you asked that strategy because there are a few different right ways to do that. That's not what this call is about here today, though. This Friday Mastermind is all about the deferred sales trust, and I'm more than happy to talk with you one-on-one about that. Helped out a number of individuals who have cash-centric businesses who have done exactly what you're talking about. Over the years, accumulated a lot of cash just in their safe, what have you. And now what do they do with all of that without raising red flags? Sometimes people end up with too much cash. And in today's ultra high regulated environment, they can have a problem spending that. And so they're, without looking like somebody who's doing something nefarious, right? We don't want that. So there is a proper way to get that back into the system and get that back into other assets without raising red flags, without causing an audit. And we can.
And somebody that last year at this time, or they're sitting on the cash, they don't know what to do with it. They're concerned about paying tax going forward on a capital gain income, so forth, and exposure to estate tax. That's not this deferred sales trust. That can't work with this, right?
There needs to be a taxable transaction first to be eligible for the trust, right? We don't set it up without a taxable event. And so if they're selling a building, if they're selling a business, if they're selling their house, any of these other large capital assets, so cash is not considered a capital asset. Cash.
All right, so let's say you have a capital asset with a high basis. Does it still work with that?
It can, depending on how much. A home run for the deferred sales trust is $1 million or greater transaction with at least $8 million of taxable event above basis. So if we have a $10 million deal and the basis is $9 million, it still works because we have at least $1 million that is taxable. If we have $1 million sell and our basis is $990,000, that means our tax is only on 10. That doesn't really make sense for anybody to participate. The reason and purpose behind that is that the tax paying has to be significant enough to warrant the tax attorneys, to warrant, Pierce, myself, Brett, and everybody else in the customer service team and all of our employees to participate to help make the deal happen. If the tax paying is not significant enough, then there are other lesser strategies that help take little bits of the tax burden away that would probably be more prudent for you to take advantage of.
Yeah, we can talk offline on that more.
Absolutely. And also I do a Tuesday presentation every Tuesday on other strategies besides the deferred sales trust that may become more beneficial for something like that. So Tuesday, Friday. Friday is always deferred sales trust and those transactions that are eligible for a deferred sales trust, which again are those that are over $1 million and have at least $1 million of net gains that are going to be taxable, which again, whether or not you might be, your transaction might have to pay not only capital gains, but the Obamacare tax or the Medicare tax, the 3.8, plus any state relevant taxes. Transactions could possibly be less than $1 million if the tax paying is significant enough depending on state taxes, depending on that Medicare tax. But an easy home run, like just a rule of thumb, like not even having to think about the deal a whole bunch. If it's over $1 million taxable gain, that's an easy, hey, we should consider this further. Let's look at the exact details. How is the entity set up, or how is the asset held? And then who is the buyer? Do we have enough time to get in front of this so that in the LOI, in the contract, and everything else, we can provide the option to use the trust? And do we have time to meet with the tax attorney? All of those other details, we decide after first we recognize whether or not it's an eligible transaction, which...
I'll see you Tuesday.
Tuesday, very good. And of course, you can reach out to us. If we want to reach out to Brett, his website, which he mentioned already, is capitalgainstaxsolutions.com. He's got a booking tab right there. If you want to reach out to me directly, I have a website. It's called strategictaxsolutions.com. A little bit different. strategictaxsolutions.com. There's also an 800 number. There on the website, you can book an appointment to review strategies, the deferred sales trust, if it's right for you, or other strategies that you can also see on my website. Again, that's strategictaxsolutions.com. There's an 800 number, 1-800-773-1848. Pierce is the owner and CEO of Kingdom Luxury Realty, and is an EXP realtor as well, and a deferred sales trust expert. Pierce, if people want to reach you, how do they reach you?
Yeah, you can reach me on my website at kingdomluxuryrealty.com, or directly on my cell phone, which is 916-878-0903, and I'll put that in the chat as well.
Yeah. So essentially, we're trying to share good information. We're trying to help people know when it's not right for them, as well as when it is. And should it be right for you, let's find out in your specific circumstance and scenario how to adjust it for the most optimized outcome from a tax flow perspective, not just a cash flow perspective. And at the end of the day, sometimes your biggest gains. Yes, Micah?
There was one other comment or question. James wanted to know the average time setup. I know that there's been some that have been executed very, very quickly, but just go ahead and let us know the average time. That's kind of more ideal.
Sometimes the average time is all about scheduling. We like to be 30, 60 days before a deal, 30, 60, 90 days. Whenever you are getting serious about a deal, if you have a letter of intent, if you're starting to negotiate price, and you know that there's going to be a buyer and seller, and you have a degree of comfort, bring us in and let's discuss. We have pulled off miracles before, but I do not say that we are in a habit of doing miracles, meaning we have done one literally in 5 days. And that was just because all the stars aligned and everything worked out. It was a real estate deal. It was a syndication. Everything kind of came together and all worked. Not always does that happen. We like there to be at least 2 weeks, if not the 30 to 60 to 90 days, depending on the type of deal. If it's a business deal, sometimes, especially if it's a C Corp, or if there's a complicated general partnership, limited partners involved, things of that nature, we oftentimes need to look at every owner's perspective and understand who is going to participate, who's not going to participate. And sometimes that takes more time. It just does. But a deal, I'll tell you this, a deal has never not happened because of us not willing to bend over backwards to help you in the time frame provided. So if a deal is ever decided not to happen, it's oftentimes because there's not enough time for all of the client's advisors to wrap their head around everything that we're presenting and providing. And we're never going to get in the way of a deal happening. We're never going to kill a deal, but we'll help people know and understand if it's right for them. And again, we will sacrifice our own joy and happiness of maybe going home at night or whatever by working with you to make sure that your deal does happen if it's an appropriate transaction.
Jake, one other thing. What is the estimated cost as far as setting up the trust with the attorney and the attorney fees?
The attorneys work on a conditional basis, meaning there's no payment unless the deal actually happens and the proceeds are sent into the trust. If that happens, the attorneys charge 1.5% on the entire deal size transaction that they provide lifetime audit protection on, and then 1.25% on anything above $1 million. So an example, $15,000 for $1 million transaction. For the second million, That's going to be $12,500. And just so on and so forth. That's what the attorneys charge, and that provides lifetime auto protection. They've been doing this 26 years. They've represented clients before court, not only federal court, but state court, state of California. Because California's tax is so high, obviously there's a lot of these that are done in California. And they at no cost to you, rather than paying the 20 to 40 to 50 whatever percent taxes that you might otherwise incur, you can pay for this lifetime auto protection. The attorneys draw it all up, laser focused, and then Brett Swartz and myself, as kind of like a team, a trustee financial advisor team, we typically do our very best on an ongoing basis to not charge more than 2% jointly. Now, why do I say him and I together? I have my entity that we charge through. He has his entity that he charges through. Sometimes assets are in physical, tangible real estate or other things that are not marketable securities. So sometimes more of the fees go towards him. Sometimes more of the fees go towards me. But as a team, him as the trustee, kind of the COO, and myself as the financial advisor or the CFO, financial director, helping provide all the options so that the CEO, who is the individual who put the assets in the trust, right, can continue to have direction and power of the assets going forward with us as their team, making sure that everything can happen in the most optimized way. So 1.5 times on the first million, 1.25, and those are the attorney fees. Brett and I charge less than 2% together collaboratively, depending on the type of assets that the person reinvests into.
Jake, how do you avoid incidents of ownership if the CEO, the asset holder, retains the ability to direct investment?
We provide a number of different measures so that it's not viewed that they retain total authority, meaning the trustee must sign off on any investment. And so there's a dual signature process. There is not a unilateral directioning of anything, as well as the trustee must be a third-party individual who is not deemed to be under your power and authority, meaning can't be somebody that you've used in the past, you had a prior business working relationship with, can't be a family member, can't be somebody who is just an order taker. Has to be somebody who can be considered a fiduciary for the assets of the trust, always maintaining the best interests of the trust in mind. However, the individuals that moved assets into the trust went from ownership of those assets to lendership. So they are the creditor. So rather than directing the assets, the creditor must approve, since they have a promissory note against the assets, and technically the trust owes them all of the assets back. The creditor must approve of any risk that the trustee might take on behalf of the assets in the trust. Does that make sense?
Yeah, it does. How does it differ from just a standard irrevocable trust where your children are the trustee? You tell them to invest in stuff, they go invest in it. How does that? Why is it that you can't use a family member with this trust?
Very, very, very good question. Now, we have to understand that out there in the world of trusts, there are more types and variations of trust than there are flavors of ice cream. And I'm a fine connoisseur of ice cream, so that's saying something, right? An irrevocable trust and this trust are not the same. So some people call this an irrevocable trust, but it's really not. It's a business trust. And it's a business trust that is working on a deferral. And so there are assets of entity layering and trust layering, and oftentimes we use irrevocable trusts. One of the most common types of irrevocable trust that I see out there is an irrevocable life insurance trust, which is built and put in place specifically for paying off this death tax, which we're not saying that you should not do that. But for purposes of being able to take the gross proceeds of a transaction minus attorney fees rather than minus taxes, so that people can be in the entrepreneurial spirit of buying and selling capital assets without cutting them into pieces every single time, the deferred sales trust allows a deferral of this transaction because we've taken the asset, we've moved it first into the trust. The trust is what sells it and collects the proceeds. And as long as those proceeds don't come back to the owner, or as long as they are not viewed to be deemed under the direct power of the owner or the owner's heirs, which is partly the answer to your question, then there's not what's considered constructive receipt. We are doing everything possible in this trust. The big strategy behind all of this is to keep the owner and the heirs from taking contractual receipt of the proceeds or the assets that are given from the sale. And this can happen time and time again, to where we are growing in a deferred sales trust 2.0 outside of the estate, kind of like an irrevocable trust, but we're able to do it without paying taxes on all of the transactions, because we first had an eligible transaction to get the assets out of the estate. Now, we got the assets, but we replaced them with a promissory note. So the initial amount, the fair market value of the amount that was moved into the trust, stays in the estate. It's only the time after that that we reinvest and we grow it, and it can grow out of the estate. But let's say we move a $10 million asset out, a house that is sold by the trust. The trust then reinvests that in Ethereum on a good day, where it goes up, and they double their money. Fantastic. That's great. The $10 million promissory note is the only thing that stays in the estate. The house that turned into cash, that turned into Ethereum, that then doubled, is what's outside of the estate. And
isn't that note then includable in the estate under the 706?
The note is included in the estate. The note stays in the estate. But the growth of what that asset was exchanged for is what grows outside of the estate. So now we've got a 20 million outside of the estate and only a 10 million in the estate. Now,
so if you want your principal back, you can get your principal back because it's still in your estate. Just call the note.
And you can get your principal back, but the creditor has creditor rights over all of the assets in the trust. So technically, you can call a redemption of the entire assets of the trust. Most people don't do that, but you could.
Right.
Now, why would you? In some future year where perhaps the United States government, instead of raising our taxes to 80%, they decide to drop it to 4% everywhere. Well, that might be a beneficial time to liquidate assets in the trust and take those gains and pay the 4%. And that's a very hypothetical scenario, no? But in our history, in different areas that have had disasters, such as Puerto Rico and other areas, they have made incentives for people to live there, such as that. And so if there's ever a beneficial time through a tax planning effort for individuals to just move assets out of the trust, we'll be the first ones to tell you, because we're staying on top of all the legislation where that might make sense. But if it doesn't need to be in your personal hands, so to speak, that is the purpose of this deferred sales trust, allowing the deferral. So we enable you to sell an asset. A lot of people don't want to sell something because they're afraid of paying the taxes, and their net is not going to be what they need or want. But if their net can be, because they're just going to pay the attorney fees rather than pay the taxes, and their goals are not so personal in nature, meaning they're not just going to build a new house to live in, they're not just going to buy a Lamborghini to drive around and look cool for their friends. They're going to reinvest the assets to continue to grow things for their legacy for an investment purpose with a business trust. Then the deferred sales trust makes sense. And we are over time, everybody. I was not watching the clock, but we had some really good questions. I appreciate those questions. Reach out, schedule some time. Let's talk. Come join my Tuesday presentation, and just take a look at my website for the times and the place for that, and register. And we'll see. If not, we'll see you here next Friday.
Where are you physically located?
Depends on the day. My preferred office and home, where I have a family and kids and everything, is here in Utah. But I also have offices in Kansas, in California, in Florida, in Mexico, and in a few other places.
And Brett is in California. And Pierce too.
Fantastic. Yep, Pierce and Brett are in California. All right. Thank you, everybody. Have a fantastic day. We'll talk soon.
Thanks, Jake.
Bye-bye now.
Thanks, everybody, for coming on.